Hello, everyone, and welcome back to the Commodities Institute podcast. I'm Emily Costa. Today is Monday, March 9th, 2026, and there is one word that really defines the current state of the commodity markets: disruption. Across oil, metals, agriculture, and global energy flows, we're seeing a cascade of effects tied to the escalating conflict around Iran and the Strait of Hormuz. What began as a geopolitical flashpoint is now rapidly translating into supply shocks, price spikes, and a reshaping of global trade flows. Today, we're going to walk through what's happening across several key commodity sectors and why the ripple effects could last well beyond the immediate crisis. Let's start with oil, because that's where the most dramatic shock is unfolding. Iraq's oil production has collapsed by roughly 70% from its main southern fields. Production that previously stood at around 4.3 million barrels per day has plunged to roughly 1.3 million barrels per day. The reason is straightforward but severe. Exports through the Strait of Hormuz are effectively blocked. Now, the Strait of Hormuz is not just any shipping lane. It is arguably the most critical energy choke point in the world. Roughly 1/5 of global oil and liquefied natural gas flows pass through that narrow corridor connecting the Persian Gulf to international markets. When that artery tightens, the consequences ripple across the entire energy system. Iraq relies on oil revenues for more than 90% of its government income. With exports dropping to around 800,000 barrels per day and tanker traffic stalling, the country's storage facilities have already reached capacity. That means production cuts are not optional. They are unavoidable. And this is happening while global oil markets are already on edge. Futures prices surged sharply as traders began pricing in the risk of prolonged disruptions. In the United States, gasoline prices are rising quickly. The national average price for regular gasoline has climbed to $3.32 per gallon, up about 11% in just a week. Diesel prices have risen even more sharply. Officials in Washington are attempting to calm markets. The US government has issued a temporary waiver allowing India to continue purchasing Russian oil, a move intended to prevent a sudden shortage in global supply. The idea is that allowing those cargoes already afloat to reach refineries could ease some of the panic in the market. But the reality is that markets are driven as much by perception as by actual shortages. When traders see a major shipping route under threat, the risk premium rises quickly. That's exactly what we're seeing now, and the effects are not limited to crude oil. Let's turn to natural gas, where the situation is equally dramatic. Liquefied natural gas prices across Europe and Asia have surged roughly 50% compared with levels a year ago. One of the biggest drivers of that surge is the sudden stoppage of exports from Qatar, which had been the world's second largest LNG exporter. With those cargoes suddenly absent from the market, buyers across Europe and Asia are scrambling to secure replacement shipments. But the LNG market has a structural constraint that oil does not. You cannot simply redirect large volumes overnight. Liquefaction capacity, specialized tankers, and long-term contracts limit flexibility. That said, exporters with spare capacity are suddenly staring at enormous profit opportunities. Forward prices for LNG deliveries into Asia are now hovering around $12.95 per million British thermal units for next year. European benchmark prices are only slightly lower. For exporters in the United States, where domestic gas prices are significantly cheaper, those spreads translate into extremely attractive margins. After accounting for liquefaction and shipping costs, the profit potential on diverted cargoes could exceed 200%. We are already seeing shifts in trade flows. The United States historically sends the majority of its LNG to Europe, but shipments to Asia have risen significantly this year as buyers compete aggressively for available cargoes. In other words, the market is dynamically rerouting supply toward whichever region is willing to pay the most. Now let's pivot to metals, because the same geopolitical disruptions are creating a very different but equally important problem there. Indonesia produces more than half of the world's nickel supply, a metal essential for stainless steel and increasingly important in battery technologies. Many of the country's nickel refineries rely heavily on sulphur imports from the Middle East. Sulphur is a critical ingredient used to produce sulfuric acid, which in turn is necessary for processing nickel ore in high-pressure acid leaching plants. These facilities operate with surprisingly limited stockpiles, often only 1 to 2 months of supply. With shipping routes through the Gulf increasingly disrupted, those sulphur deliveries are now at risk. Analysts warn that if alternative supplies cannot be secured quickly, nickel producers may be forced to cut output within weeks. And here's where things become even more interconnected. Sulphur is also vital for copper mining operations, particularly in Africa, where it is used in similar leaching processes. Fertilizer manufacturers rely on it as well. If supply tightens significantly, these industries could find themselves competing directly for limited inventories. Prices were already elevated before the conflict began, hovering around $500 per ton. They have since climbed further. If vessel flows remain constrained, it is highly likely we will see additional price increases and potentially production slowdowns across several sectors. Now let's move briefly into agriculture, where the story is less about conflict and more about shifting production expectations. Ukraine's grain harvest for 2026 is projected to decline by about 4% to roughly 58.6 million tonnes. The biggest contributor to that drop is expected to be a smaller wheat crop. Interestingly, despite the slightly lower harvest, exports may actually rise modestly. Analysts believe improved logistics and stronger corn shipments could push total grain exports to nearly 42 million tonnes during the upcoming marketing year. Meanwhile, in South America, Brazil's soybean harvest is progressing but at a slower pace than last year. Farmers have completed just under half of the harvest so far. That pace is slower than the previous 2 seasons, but still broadly in line with historical averages. Weather delays earlier in the growing cycle pushed back planting schedules, which in turn extended crop development timelines. The good news is that yields appear relatively solid overall, suggesting global soybean supply remains stable for now. Finally, let's close with a development in the steel market that highlights the broader resilience of global industrial demand. India's finished steel exports have surged more than 36% year over year, reaching roughly 6 million tonnes during the first 11 months of its financial year. At the same time, the country's steel imports have fallen sharply. That combination reflects a strong domestic industry that is both expanding production and capturing export market share. Steel consumption inside India is also rising steadily, underscoring the country's ongoing infrastructure and industrial growth. When you step back and look across these markets, a clear theme emerges. Geopolitics is once again reshaping commodity flows at a global scale. A single choke point in the Middle East is influencing oil supply, LNG pricing, nickel processing, fertilizer production, and even the economics of global shipping routes. Commodity markets are interconnected systems. When one link in that chain breaks, the consequences spread rapidly across sectors that might initially seem unrelated. Over the coming weeks, traders will be watching 3 things very closely. First, whether shipping through the Strait of Hormuz stabilizes. Second, how quickly alternative LNG supplies can reach Europe and Asia. And third, whether industrial supply chains from nickel refineries to copper mines can secure critical inputs like sulphur before inventories run dry. If those pressures persist, we could be looking at one of the most complex commodity disruptions in years. And that's all for today's episode. If you found this episode valuable, be sure to subscribe, share, and leave a review. Thanks for listening to the Commodities Institute podcast. I'm Emily Costa, and I'll see you next time.